There's a guy who retired at 42, not because he sold a startup, not because he inherited money, because he figured out something the financial industry absolutely hates to admit. You can build a machine that prints money every single month, and you can start with literally $0. Another person I know spent 30 years in a 401k, did everything right, saved 15% of every paycheck, and you know what they got? The privilege of maybe retiring at 67 if the market doesn't crater right before they need the money. Meanwhile, dividend investors who started 10 years ago are collecting checks that cover their mortgage, their groceries, their car payment, everything. And they're not even 50 yet. Here's the part that makes me laugh. The entire retirement industrial complex, the advisors, the fund managers, the talking heads on financial television, they all push the same playbook. Accumulate a massive pile of money, pray it lasts, and spend your 60s wondering if you can afford to actually enjoy retirement or if you need to ration your own life savings. It's insane. So I'm going to show you exactly how dividend retirement actually works, the real math behind building income streams that never stop, why the traditional model is designed to keep you working until you're too old to enjoy freedom, and the specific strategy that can get you there in 10 years, even if you're starting from absolute zero today. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Think of dividend investing like building a vending machine empire. When you buy a regular stock, you're hoping someone pays you more for it later. That's speculation. You're trading pieces of paper. But when you buy dividend stocks, you're buying vending machines that spit out cash every single quarter, whether anyone wants to buy your machine or not. The game isn't selling the machines. The game is collecting enough quarters that you never have to work again. Now, most people hear this and immediately think high-yield dividend traps. Penny stocks paying 8% that cut their dividends 6 months later. That's not what I'm talking about. I'm talking about companies that have paid increasing dividends for 25, 30, even 50 consecutive years, through recessions, through market crashes, through actual world wars. These are businesses so profitable, so entrenched, that they print money in good times and bad times. Here's what nobody tells you about the math. You don't need millions. You need around $800,000 to $1 million invested in quality dividend payers, yielding 3 to 4% to generate $30,000 to $40,000 a year in passive income. That's not Lambo money. But for a lot of people, that's freedom money. That's, I don't need this job anymore money. That's, I can choose what I do with my time money. The question is, how do you get to $800,000 starting from zero in 10 years? The answer is going to surprise you because it's not actually about picking the perfect stocks. It's about understanding a psychological shift that most investors never make. There's a story about a guy named Jim who worked at a mid-sized insurance company, made about $70,000 a year. Nothing spectacular. In 2015, he started putting $500 a month into dividend ETFs. Just $500. The first year, he made maybe $250 in dividends total. He told me he almost quit because it felt pointless. $250 for an entire year of investing felt like a joke, but Jim kept going. Year 2, he made about $500 in dividends. Year 3, around $800. Still seems slow. Here's what changed everything for him. In year 4, his dividends crossed $1,500, and he realized something. He hadn't increased his monthly contribution, but his dividend income had doubled from the previous year. The machine was starting to feed itself. See, when you reinvest dividends in the early years, you're not just earning interest, you're earning interest on your interest, which earns more interest. But more importantly, you're buying more shares, which pay more dividends, which buy more shares. It's exponential, not linear. The first 3 years feel like pushing a boulder uphill. Years 4 through 7, the boulder starts rolling on its own. Years 8 through 10, you're just trying not to get run over by the momentum. This is where most people fail. They expect immediate gratification. They put in $5,000, make $200 in dividends, do the math, and think this will take 40 years. They quit. They go chase options trading or crypto or whatever's hot. They don't understand that dividend investing is a J curve. It sucks for a while, then it doesn't, then it's unstoppable. Let me show you the actual numbers because I'm obsessed with actual numbers. Let's say you invest $1,000 a month in a portfolio yielding 4% annually with dividends reinvested. Year one, you invest $12,000, you receive about $480 in dividends. Total portfolio value, around $12,480. Year five, you've invested $60,000, but your portfolio is worth around $72,000 because of dividend reinvestment and modest capital appreciation. Your annual dividend income is now around $2,880. You're thinking, okay, still not life-changing. Year 10. You've invested $120,000 of your own money. Your portfolio is now worth approximately $210,000. Your annual dividend income is $8,400. That's $700 a month, passive, every single month. But here's the trick. If you can increase your contributions over time, even modestly, the numbers go completely insane. Let's say you start at $1,000 a month, and every year you increase your contribution by just 10%. Maybe you get raises, maybe you cut expenses, maybe you pick up a side gig. By year 10, you're contributing around $2,300 a month, but early contributions have been compounding for nearly a decade. Under that scenario, by year 10, you've invested around $180,000 total. Your portfolio is worth approximately $350,000, and you're generating $14,000 a year in dividends. That's over $1,000 a month in passive income, and you're only at the halfway point to full retirement. Now you're asking yourself, what happens if I keep going? Year 15, assuming the same trajectory, you're looking at a portfolio worth $700,000 to $800,000, generating $30,000 plus in annual dividend income. Year 20, you're over $1.2 million with $50,000 a year in dividends, and you never have to touch the principal. This is the piece that traditional retirement planning gets backwards. They tell you to accumulate $2 million, then withdraw 4% a year and pray it lasts. That means you're slowly liquidating your life savings, hoping you die before the money does. It's a reverse countdown to zero. Dividend investing says build $1 million machine that spits out $40,000 a year forever. And when you die, your kids inherit the machine, not a depleted account. But you might be thinking, where does the money actually come from? What are these magical companies paying dividends through recessions? Let me tell you about the dividend aristocrats. These are S&P 500 companies that have increased their dividend every single year for at least 25 consecutive years. We're talking about Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's. These aren't sexy tech startups. These are boring, profitable, essential businesses that people need in good economies and bad. There's a reason Coca-Cola has paid a dividend since 1920. People drink Coke in recessions. There's a reason Procter & Gamble, which makes Tide and Pampers, has paid dividends for over 130 years. People need to wash clothes and change diapers regardless of what the stock market is doing. These companies have pricing power, global distribution, and moats so wide that competitors can't touch them. The Dividend Aristocrats Index has outperformed the S&P 500 over the long term with lower volatility. You get paid to wait, and the companies you own keep raising your payment every single year. Inflation goes up, your dividend goes up. Market crashes, your dividend keeps coming. It's the closest thing to a free lunch in investing. Now, I'm not saying buy individual stocks if you're just starting. Most people don't have the time or knowledge to analyze balance sheets. This is where dividend-focused ETFs come in. These are baskets of dividend-paying stocks that do the work for you. You buy one share of the ETF, you own pieces of 50, 100, sometimes 500 dividend-paying companies all at once. There's one called SCHD, the Schwab US Dividend Equity ETF. This thing holds around 100 high-quality dividend stocks, yields about 3.6% annually, and the dividend has grown almost 11% per year over the past 5 years. You're not just collecting income. You're collecting income that grows faster than inflation, which means your purchasing power increases every year even if you never add another dollar. Another one, VYM, Vanguard High Dividend Yield ETF, holds over 400 stocks, yields around 3%. It's more diversified, more stable, and has an expense ratio so low it's basically free, 0.06% annually. For every $10,000 you invest, you pay $6 a year in fees. The financial industry charges 1% or more for actively managed funds that underperform these index funds 70 to 80% of the time. Here's where it gets interesting. Some people, once they understand the game, they start adding higher yield positions to accelerate the income. REITs, real estate investment trusts, are legally required to pay out 90% of their taxable income as dividends. You get yields of 4, 5, even 6% from publicly traded REITs that own everything from apartment buildings to cell towers to data centers. There's an ETF called VNQ that holds a basket of REITs, yields around 4%. You're getting real estate exposure, dividend income, and you don't have to deal with tenants or toilets. It's passive real estate income without the landlord headaches. The catch is, REITs are sensitive to interest rates. When REITs go up, REIT prices often go down. But if you're reinvesting dividends and holding for 10 years, short-term price swings don't matter. You're collecting rent checks every quarter. Now I need to address the elephant in the room. Taxes. Dividends are taxable. If you're doing this in a taxable brokerage account, you're paying taxes on those dividends every year, even if you reinvest them. Qualified dividends are taxed at long-term capital gains rates, which is better than ordinary income, but it's still a drag on returns. This is why the smart play is to do this inside tax advantage accounts first. Max out your Roth IRA, $5,000 a year if you're under 50, $6,500 if you're over. Every dollar of dividends in a Roth grows tax-free forever. You never pay taxes on it again. If you can max out a Roth IRA and invest in dividend ETFs inside it, you're building a tax-free income machine. If you have access to a 401k and your plan offers low-cost index funds or dividend-focused funds, max that out too. The contribution limits are way higher. $23,000 a year in 2026 if you're under 50. That's almost $2,000 a month you can invest pre-tax, lowering your current tax bill while building future income. The ideal strategy is Roth IRA first for tax-free income, 401k second for tax-deferred growth, and employer match if available. Then taxable brokerage account for anything beyond that. The order matters because taxes are the single biggest drag on long-term wealth building. But here's a psychological barrier most people hit around year 3 or 4. They see their portfolio growing and they want to spend the dividends. They think, I'm making $2,000 a year in dividends, I deserve a vacation. That's the moment you lose. Because if you spend those dividends in year 3, you don't get the compound effect in year 7. You rob your future self to reward your current self. There's a concept I learned from running my own business for over 10 years. Delayed gratification is the only real edge you have. The market doesn't care how hard you work. It doesn't care about your story. It only rewards people who can stomach short-term discomfort for long-term gain. Every time you reinvest a dividend, instead of spending it, you're buying another vending machine. Every time you spend it, you're eating the quarters instead of buying more machines. I watched a guy blow this exact strategy because he couldn't delay gratification. He built his portfolio up to around $80,000 in 5 years, was generating around $3,000 a year in dividends. Then he bought a new truck, withdrew $30,000, cut his portfolio by more than a third. You know what happened? His dividend income dropped to $2,000 a year. He extended his timeline to financial independence by at least 5 years because he wanted a truck today instead of freedom tomorrow. Now let me give you the realistic version. The version where things go wrong, because they always do. Let's say you start investing $1,000 a month. Year 2, you lose your job. You have to stop contributing for 6 months. Your portfolio drops 20% in a market correction right when you're out of work. Most people panic sell. They think the strategy failed. They bail out, lock in losses, and go back to thinking investing is rigged. But here's what actually happens if you hold. Dividends keep coming even when the stock price drops. In fact, when prices drop, your dividends buy more shares at cheaper prices. It's called a dividend reinvestment sale. You're buying the same companies, the same cash flows at a discount. If Coca-Cola drops 20% but still pays the same dividend, you just got a 20% better deal on future income. The people who win at dividend investing are the ones who keep reinvesting through crashes. 2008, financial crisis, dividends dropped temporarily, but the dividend aristocrats kept paying. People who reinvested dividends in 2008 and 2009 bought quality companies at fire sale prices. By 2012, their portfolios had recovered, and they were sitting on massively higher income streams because they bought low. This is why I'm obsessed with dividend growth, not just dividend yield. A stock yielding 7% that cuts its dividend in a recession is a trap. A stock yielding 3% that raises its dividend every year for 30 years is a compounding machine. I want companies with such strong cash flow that they can raise dividends even in bad times. There's a company called Procter & Gamble, paid dividends since 1890, raised its dividend for 67 consecutive years. 67 years. It raised dividends through the Great Depression, through World War II, through the dot-com crash, the financial crisis, COVID. If you owned Procter & Gamble in 1957 and reinvested dividends, you'd be collecting dividend checks worth more than your original investment every single year just from one company. This is the power law of dividend investing. Time plus reinvestment plus quality companies equals financial independence. You don't need to pick the next Amazon. You need to own boring, profitable businesses that pay you to wait. Now, the acceleration technique nobody talks about. Once you hit a certain threshold, let's say 150,000 to 200,000 in your dividend portfolio, you can start using a strategy called tactical reinvestment. Instead of automatically reinvesting dividends, you collect them in cash and wait for opportunities. Market drops 10%, deploy the cash. A quality dividend stock gets unfairly punished by bad news, buy more. This is what separates people who retire in 10 years from people who retire in 15. The automatic reinvestors do fine. The tactical reinvestors who buy the dips, who deploy cash when others are panicking, they accelerate their timeline by years. But you can't do this until you have enough capital that your dividends are meaningful. In the early years, just reinvest automatically and let the machine build. Let me tie this back to the psychological piece, because this is where I think most people fail. Dividend investing requires you to rewire how you think about money. Most people see money as something to spend. They earn it, they spend it, they earn more, they spend more. It's a treadmill. Dividend investing requires you to see money as a tool to buy freedom. Every dollar you invest is a soldier you send out to capture more dollars. Those dollars come back with prisoners, the dividends, and you send those prisoners back out to capture more. It's a compounding army. But if you keep pulling soldiers back to buy stuff, your army never grows. You stay stuck. I've been investing for over a decade. I have multiple hundreds of thousands of dollars in dividend-paying stocks and ETFs. I still drive a car that's 7 years old. I still cook most of my meals. I still think twice before buying stuff I don't need. Not because I can't afford it, because every dollar I don't spend is a dollar that works for me forever. That mindset shift from consumer to capital allocator is the real edge. The financial industry doesn't want you to figure this out, because if you build a self-sustaining dividend portfolio, you don't need their high-fee mutual funds, you don't need their annuities, you don't need their financial advisors charging 1% a year to underperform an index fund. You become financially independent from the entire system, and that's terrifying to them. Here's what they'll tell you. Dividends are tax inefficient. You should focus on total return. Buy growth stocks, sell when you need money. And you know what? For taxable accounts, there's some truth to that, but they ignore the psychological and behavioral advantages of dividends. When you're collecting cash every quarter, you're less likely to panic sell in a crash. You have a tangible reminder that you own real businesses generating real cash flow. It keeps you invested when emotions scream at you to sell. I'd rather have a portfolio that pays me $40,000 a year in dividends that I can see, touch, and spend than a $2 million portfolio that I have to sell shares from and pray the sequence of returns doesn't destroy me in a downturn. The math might favor total return in a spreadsheet. The psychology favors dividends in real life. And real life is where you actually have to execute the plan for 10 years without quitting. Here's the playbook. Year 1 through 3, invest as much as you can, reinvest every dividend, live below your means. It's going to feel slow. Do it anyway. Year 4 through 7, increase contributions as your income grows. Consider adding higher yield positions like REITs. Stay disciplined. This is where the compounding starts to feel real. Year 8 through 10, consider tactical reinvestment if your portfolio is large enough. Protect the downside and start envisioning what life looks like when you don't need a job. By year 10, if you've invested consistently, reinvested dividends, and avoided major self-inflicted mistakes, you're either fully financially independent or close enough that you can see the finish line. And here's the beautiful part. The income doesn't stop at year 10. It keeps growing. Your portfolio in year 15 is generating twice the income it did in year 10. Year 20, it's 4 times. You're not just financially independent, you're wealthy. Now let me give you 3 specific actionable takeaways because I'm not here to motivate you. I'm here to give you a blueprint. 1, open a Roth IRA this week if you don't have one. Vanguard, Fidelity, Schwab, doesn't matter. Pick one. Fund it with whatever you can, even if it's $50. Buy a dividend-focused ETF like SCHD or VYM. Set up automatic monthly contributions. The account takes 10 minutes to open. If you wait for the perfect time, you'll wait forever. 2, commit to living on 90% of your income starting today. Take the other 10%, invest it in dividend-paying assets, and never touch it. If you get a raise, invest the entire raise. If you can't live on 90% of what you make now, you have a spending problem, not an income problem. Fix the spending. 3, track your dividend income separately from your portfolio value. Every quarter, write down how much you received in dividends. Watch that number grow. It's the only number that actually matters for financial independence. Portfolio value goes up and down. Dividend income, if you pick quality companies, only goes up. Focus on the income, not the net worth. Lazy investing built more fortune than crypto memes. The people getting rich aren't the ones chasing 10-baggers. They're the ones collecting quarterly payments from businesses that have paid dividends since before their grandparents were born. Start building your machine today, or spend the next 30 years hoping your 401k doesn't implode right before you need it. The choice is obvious.